Hi everyone, and welcome to today's exclusive alumni webinar. We have Morgan Hardy here, and he is talking to us all about the world of tax. He established Indirect Tax Solutions to help New Zealand exporters sell New Zealand goods and services to the world. Morgan has been working in the tax field for over 20 years with experience in both practice and commercial roles from multinational consultancies and companies. So welcome, Morgan. It's really great to have you here.
Thank you, Brian. I'm really pleased to be here. I love what you're doing at the Icehouse, so very pleased to be able to help out.
Totally. The world of tax, I think probably when business owners hear the word tax, they go, and they shudder a bit. So that's exactly why we've got you here, is to be able to sort of fight some fires and answer some questions.
I'm well used to seeing the eyes glaze over when I start talking about tax, but yeah, what we want to do here is just identify a few red flag things to be aware of as business people go around their journey of growing globally.
Awesome, that's so good. Well, you take it away, and then I've got some questions from the community that I'll make sure to ask once you've finished your presentation.
Perfect. Okay, well, get going. Thank you very much for that.
No worries.
How's that? Great. Okay, so thank you for the introduction. What we're talking about here today is indirect tax, and very broadly, tax can fall down to two buckets. You've got direct tax, which is your income tax, which is tax paid directly to a tax authority, and then indirect tax, which is generally paid through some other party. So that's your examples are your GST, VAT, and sales tax. So when, as a consumer, I buy a product, what amount I pay to the vendor is the cost plus an element of tax, and with GST and VAT, the vendor then has to pay their net GST over to the government. The reason for focusing on indirect tax is it's an area that has expanded a lot in the last few years, and the purpose here is just to go over a bit of that, a few of the things to look out for. Just got a quick graph in here just to show how, this is looking at VAT specifically, how VAT regimes have increased over the last 30 years. As you can see, as of 2018, the last year the OECD provided information, there was 168 countries that had some form of VAT. So it really started to snowball with the EU, but now it's throughout Asia and Africa as well. The question is about why I think indirect tax is so important. I think it is the underestimated challenge to New Zealand exporters, and that's for two reasons. Firstly, in tax and accounting, we're often in danger of being country siloed. So we're in New Zealand, we think about New Zealand tax. And certainly in terms of income tax, that's the way it's largely been, that unless you establish an office overseas, you don't have to worry about another country's tax system. That's all changing with indirect tax. So the first point is the silo. The second point is the fact that this is an area that is rapidly increasing in scope. And I do believe over the next few years, we're going to see indirect taxes pushed a lot harder when governments try and rebuild their balance sheets, particularly after all the spend around COVID. So, and I think for a lot of countries, the easiest targets for tax will be foreign businesses. So I think indirect taxes are going to be as much an issue for chief operating officers as well as CFOs. And to look at the reasons how it will impact exporters, on the good side, if VAT isn't paid when it's required, we can find non-delivery or late delivery of goods, or even additional charges and handling fees to the customer to have their goods cleared and the tax paid, which generally would not result in a very happy customer. And for the technology companies, particularly SaaS providers, increasingly countries are looking at making sure that SaaS products are taxable. And while there may not be a mechanism for collecting the sales tax or GST at the border, where the tax is not addressed, we'll find that the exposure to penalties and interest will accumulate quite quickly. And when it comes time for any, like a liquidity event, either for funding or for a sale, that's the point when due diligence is going to be undertaken and any exposures probably identified, and that could quite seriously impact the any sale or other attempt to raise funding. So I do think it's a challenge to exporters that's only going to grow in the next few years, and it's my advice to people is to make sure that they are just aware of it and seeking advice and keeping their advisors in the loop to ensure that they are on the right track. And I think another last point in terms of looking at these liabilities, it's a lot of people might be thinking, well, at the moment I'm quite small and don't need to worry about it. I think what people need to be thinking about is where do I want the business to be in 3 years' time, 5 years' time, and what's my business going to look like then? What am I going to be doing? But also how technology is improving the tax authority's ability to detect and chase taxpayers, because that's rapidly increasing as well. We're making various comments around tax regimes here. These are sort of general comments. Individual tax liabilities will be determined by where you're based, what you're selling and how you're selling it, whether it's through distributors or directly, and also the location of the customer. So it's always important to ensure that your specific facts are looked at when you're taking advice. As an example of how indirect tax can trip up, here's a case study that I came across a few years ago, an actual example. This dealt with a publisher who was selling magazines into Canada. They decided to change their distribution network and use a Canadian distributor to distribute to the subscribers and to newsstand outlets. They negotiated terms with the distributor. Under those terms, the distributor agreed to pay the import clearance costs, so that was duty and GST in Canada, and they would charge the duty back to the publisher, but not the GST, on the basis that they would then reclaim that. However, nobody actually changed the import process so that all of the importer of record remained the publisher rather than the distributor, and while the distributor merely carried on claiming the GST, when they had an audit some years later, the tax agent looked at the import documentation and said, well, actually, this isn't your GST, you can't claim it. So that was 3 years worth of import GST, which amounted to several $1 million that they were assessed for, and obviously started quite a serious discussion between them and the publisher. So it's quite important to ensure that the processes are right, because you may not notice a problem in the beginning, but it generally will come back to bite in the end. Why is this happening? Why are we seeing a lot of change now? I think the key thing is that consumption taxes, so indirect taxes, are being seen as the preferred revenue raising tool across most of our export markets. The tax world has been grappling for some time with how to tax the digital economy, and the OECD tried a few years ago to get an agreement between all the countries involved, OECD countries, on how the digital economy should be taxed, and how they might amend the international double tax agreements that are in place between countries to try and smooth trade to accommodate the digital economy. Unfortunately, they couldn't reach agreement, and so what countries have ended up doing is moving towards their indirect tax systems, the GST, VAT and sales tax, because all of those taxes fall outside international double tax agreements, and therefore they don't need to negotiate the imposition of those with any other countries. They just do it. And so the tax authority is saying, right, we'll follow the destination principle. If the destination of your product is in my country, I'm entitled to a share of tax revenue in relation to that trade, and the way we'll do it is through indirect tax, because I can just go ahead and do it, and there's no need to worry about negotiating on double tax agreements, and therefore this is rapidly changing the risk profile of doing business exporting to various countries around the world. In terms of an overview of global indirect taxes, the key point here is the devil is always in the detail. As I said before, the tax result will depend on your specific facts, and you should keep your advisor in the loop. Another key question will be whether your business model is a B2B model, whether you're selling business to business, or whether you're selling direct to consumer. At a high level, if you're selling business to business, you're going to have less of an issue with indirect taxes. In Australia, UK and the EU, they rely on what we call the reverse charge principle, so that a business purchaser will self-assess the VAT or GST they need to pay, and then recover that if they're entitled. So for B2B transactions, there is largely no need to account for GST or VAT. Slightly different in the US. The US sales tax is based on the principle of the end consumer. So where a business is the final consumer, for example, if they are purchasing a technology product that they're using to operate their business, and they're not on selling that or anything, then they become the final consumer, and the tax will need to be collected. So key thing to always bear in mind is you've got generally differing rules whether you're B2B or B2C. If we're quickly looking at where you might need to have a closer focus, the product that you're selling is also quite important. I've got here a little bit of a heat map showing green areas where there's generally going to be a lower risk. The lighter green, the lime green, low risk. The lighter green is where there's a few complexities to be considered. Orange is where the rules vary quite a bit, and so it's quite location specific. And the red is where pretty much you're going to have to think about the tax. So if we look at EU and UK, generally if you're B2B, you should be not having any concern. If you're doing B2B in the US operates a system of various exemptions. As mentioned before, the aim is to levy the tax only at the final point of consumption and not at every stage along the supply chain as we do in New Zealand with GST. So there are exemptions for resellers. So if you are selling to a retailer that's going to sell a product, that will generally be subject to a reseller exemption, and provided you can get a reseller certificate from that customer, then you will not have to collect sales tax, and it'll be exempt. Also, if your customer is a government, it's federal government, they are generally exempt from sales tax as well. But once again, you should hold a exemption certificate, because if you're audited, any auditing agent will want to see the certificate as the basis for why tax wasn't collected. And if there's no exemption certificate, their first attempt will be to try and impose tax. Similarly, also with farming and agricultural products, there are quite broad exemptions in the agricultural industry, because most inputs go into producing farm goods. So there are large exemptions there. Where in the B2B space, you do need to consider sales tax is with manufacturing consumables and other B2B tangible products, so generally around goods. So if you're selling widgets to a customer in the US who is not on selling them, then it's an area you need to look at more closely. However, across the US, there's quite broad exemptions for grocery items. So whether you're selling B2B or B2C, grocery items, that's food and beverages, are generally not taxable. of the, I think, 46 states that have a sales tax, only about 2 or 3 actually levy sales tax on grocery items. So if you are selling grocery items, that is an area where hopefully you won't have too much difficulty. But a key point to note there is it can get a bit tricky around health products, because if they are not considered to be a grocery item that's a substantial part of a meal, if they are vitamins and supplements, then they could fall out of the grocery definition and be taxable. So that's a key point just to be aware of. With software, generally services are not subject to sales tax in the US. This is an area that's probably changing, but if you're providing services, there's a good chance that sales tax will not be an issue. However, if you are producing canned software, as they like to call it in the US, and that includes SaaS products, where you're offering a license to use a specific program, and that program has not been designed, not a bespoke design, then roughly half of the states in the US will potentially tax that software. Moving into the B2C market, this is where the EU and UK becomes a lot more relevant. The EU and UK have had taxes on the sale of particularly B2C software and goods for a number of years. There's been a key change in the UK from the beginning of January. So the mechanism for collecting VAT in the EU and UK, much like GST in New Zealand and Australia, is through the customs process, through the import mechanism. So when you are importing goods, VAT will be charged at the border. A recent change in January was to remove the exemption for low value items. So if you're selling and delivering from outside of the UK after 1 January, any goods in a consignment of £135 or less, there is now a requirement to collect VAT at the point of sale, and of course register and then pay over that VAT. The UK, the EU is bringing similar rules from the 1st of July. Under those rules, if the consignment is €150 or less, then VAT needs to be collected at the point of sale. Now, if your model is using a 3PL or on-site warehouse in those countries, you'll be doing the input process before the sale, so these rules wouldn't apply, but you will have a domestic or local supply where there'll be a need to charge GST and VAT, and you'll want to make sure that you are recovering the VAT on import that was charged. So in terms of changes, I mentioned about the UK change and the EU change coming up. A key change in the US from 2018 has really changed the landscape here. And I think this is an area where a lot of exporters stand to get caught if they're not aware of the risk. Historically in the US, the idea was that in order for a vendor to have to collect sales tax, you needed to be selling firstly a tangible product, and you needed to have some form of physical presence in the relevant state to create what they call nexus. Nexus being having sufficient connection with that state whereby you become required to register and charge sales tax on your sales. So in 2018, there was a Supreme Court case, South Dakota v. Wayfair. And that case overturned decades of case law that had required some kind of physical connection with the state. And the rules that were introduced were provided, the court side provided a business had a sufficient level of transactions with a customer's estate, and it's measured either in the level of sales. In South Dakota's case, that was $100,000 US, or a sufficient number of transactions, and many states have chosen 200 transactions, then even if you had no other category of nexus, then the state would not be struck down if the state was to introduce what they're calling economic nexus rules. And so following that case, 45 states, including Washington DC, have now introduced what they call the economic nexus rules, whereby an out-of-state or a remote seller can be required to account for sales tax if their only connection is selling into the state. So 45 states have introduced these rules. Most of them were introduced from the beginning of 2019, and they provided a 12-month measurement window to see whether the thresholds had been exceeded. So for companies doing business through 2019, if the threshold has been exceeded, then the clock is ticking, and unfortunately liability will be growing. So people who have been selling to the US for a while probably want to be aware that from 2019, these economic nexus rules changed the playing field, and if it hadn't been looked at before, it's probably worth just kicking the tires on the way you are selling, and particularly if you're starting selling in the US, making sure you are tracking your sales by state. So that in the end, if you do have an inquiry, you're able to back up your level of sales and address any queries. This is a quick slide. I'm happy to share these slides that identify the states where, and states in green are the ones where economic nexus has been introduced. The states in orange have no remote seller requirement. However, Florida has just in the last week indicated that they are going to also bring in a remote seller, an economic nexus test. So Florida is also joining the game. I very briefly mentioned with US sales tax how the key term there is nexus. There's a two-level test to look at. One is, do you have nexus? And the second is the product taxable? Economic nexus is one category, but there are also other categories. If you have an affiliate or agent in a state, that can cause nexus. If you are using a marketplace, so for example, selling via Amazon FBA, then that can create nexus. Although certainly with likes of FBA and other online marketplaces, many states have brought in online marketplace rules that actually make the online marketplace holder responsible for the sales tax. So Amazon will actually calculate and collect sales tax on your behalf, and it will actually pay over that tax to the relevant authority, but you are still required to file a sales tax return in the relevant state, identifying those sales as being accounted for by Amazon. And a potential fishhook is that people that are selling through Amazon may look at those sales and think they're all being dealt with Amazon, and therefore if they have any other channels, that they're quite small by comparison. When we're looking at the economic nexus, so looking at the value of sales, in order to determine whether you have liability for your other channels, in most states, you need to take the sales through Amazon as well as your other channels in determining whether you've exceeded that nexus. So if you have or are building other channels alongside an online marketplace, you can't just assume that because the online marketplace is handling sales tax for the bulk of them, that your smaller channel is immune. If you have nexus, then that flows over to your other channels as well. Other key points to note with sales tax is that the rules do vary state by state, and because there is no federal sales tax in the US, but also the US has both state and local taxes. So there will be, for those states that have sales tax, there will be a statewide tax rate, but then individual municipalities may choose to levy their own local tax, and that can be at the county level or the city level or even a local district level. So the actual tax rate that is required is the amalgamation, the aggregate of each of those. So in terms of how these sales taxes work, I've largely covered that already. As I say, I'll share these slides if you want to read through that. But the key points to note between sales tax and VAT is that VAT is charged at each stage along the supply chain, and sales tax, retail sales taxes, the aim is to identify only the final end consumer. And what that does do is put the onus on traders who are selling further on down the supply chain. The onus becomes one about managing exemption certificates and being able to prove that your sale was indeed exempt. In terms of tax tools, there are a number of service providers that provide tools that can help to manage the compliance and return filings and even the certificate of exemption management. Some of the large ones are Avalara, which is probably the largest global supplier, TaxJar, who specialise in e-commerce, and Quaderno, which is a European-based provider. There are quite a few others, Taxify, and numerous smaller outfits. And these, as I've heard about Avalara, it's not cheap, but it is good, and definitely vouch for that. The key thing to note with all of these products is they're generally a great platform to meet your compliance obligations, and in respect of trying to identify for US sales tax the correct rate to charge, they will have calculations in the back end to ensure that based on the customer's address, they will collect the right rate of tax. So that takes a huge headache away. What they don't do, and which is where a bit of a potential trap is, they'll, on the websites, they'll provide massive amounts of technical information, but the onus is really on you as the user to identify any changes in your business or product that might change the taxability or the location in which you are taxable, and the onus still remains on you to register in the various state and ensure that you identify new sources of liability, and then instruct the platform to start collecting sales tax in that jurisdiction and filing returns. There can be options for a full outsource model through these, and again, it depends on whether or not that suits your business model. So these platforms, I think they are fantastic. You just need to make sure that you understand what your obligations are to ensure you get the best out of them. In terms of what Indirect Tax Solutions does, I do think this is an area that's going to be an increasing pain point for exporters, and so the whole export industry is a passion of mine. So my aim is to take a hands-on approach to both providing guidance on the risks and managing the tax compliance, whether it's using some of these other tools to automate or using internal solutions to automate those processes, and really taking the pain away. But really, there's two areas where I can assist. One is with giving a health check, a warrant of fitness, and making sure that you identify potential surprises, working with you to ensure that the systems are in place to properly account for and ensure you can file your returns if you want to do it yourself, or do it or point in the direction of a third-party tool that will help to do that for you. And a little bit about me in the slide, but I think Briar's already given an overview, so I think I've talked enough. I will pass it back to Briar to help us wrap up.
Awesome. Thank you, Morgan. That was awesome. That was great. Lots of insight there. And I think it sums it up saying that the devil's in the detail, just a whole lot of detail in this world, that's for sure. So it's cool that you, like you said, take a hands-on approach to try sift through everything and sort of pick out what the business owner needs to know to move forward. Some really helpful things in there. A highlight for me was hearing, you know, it's okay, because we hear it a lot, even with people jumping on our programs here at the Icehouse. They're going, oh, I can't do that yet, I'm too small. But actually, where are you planning to be in 3 to 5 years? I think that's super important to be reminding yourselves as a business owner, is if you're planning to grow and expand, then this is definitely something to keep tabs on. Would you agree? Well, of course you would, you did it.
I often say, if your commercial strategy is to stay small and unnoticed, then yeah, ignoring it probably okay. But if you don't want to stay small and unnoticed, then no time like the present, because particularly if you are looking at an exit in 3 to 5 years' time, you don't want to start doing it just before that exit state, preparing for that.
Yeah, of course. Yeah, totally. A couple of questions from the community as such. First one being, for a business owner who's looking at selling a physical product online through their own website for delivery in the US market, what are some ways that they could manage risk around interruption of delivery to customers?
Good question. So with the US, in contrast with the US, with the UK and EU, the customs process in the US does not involve collection of sales tax at the border. So whereas in the UK and EU they do, and that can cause serious delays, there is no mechanism to really stop and await payment of the sales tax. And so it shouldn't really impact the customer experience too much, because the tax authority can't really get involved at that point. However, the Border Force does share the information from the customs declarations with the states. So while the customer experience may not be directly impacted upon delivery, the state will be aware of the fact that there is goods being delivered. And I think there's one extra thing to talk about with sales tax in the US is the US, most states have what they call a use tax, which comes in as a backup. And so the use tax rule generally state that if you haven't been charged sales tax, then it's your obligation to charge it yourself and remit that. So most businesses have to go through the process of charging themselves sales tax under the use tax requirements, which incidentally doesn't get you off the hook for charging sales tax. Your customers can charge themselves use tax, and the tax authority will still go after you for sales tax if you're supposed to collect it. So there is a mechanism whereby your customers can be notified to the tax authority, and they can then use that to check up to see whether use tax has been collected. In reality, probably on B2C side, it's probably a bit too small, but there is a mechanism in place.
Okay, awesome. It really interests me that there's a lot differs between, countries and states and all that sort of stuff.
Yeah.
That was sort of what I was like, oh, wow, this is a lot bigger than just a one rule for all situation. Another reason to sort of have, be on the pulse of that sort of stuff as a business owner, which is cool. Another one here we have, what are the benefits of a distributor model for exporters, either brick and mortar or online based, in limiting the risk of uncertain international tax liability?
Yeah, so again, just slightly by region, I did touch on similar to this. If you're looking at UK and US, so UK and EU, there is tax charged through the import process. So if you want to use a distributor, and it doesn't actually have to have a distributor that takes ownership of the product, you can also use a 3PL in country, or there are various logistics firms that will make warehouse space available to you if you store goods in country, and that will then allow quicker delivery time to your customer. So the advantage of using a distributor will probably be that you control that import process, so you can ensure that there are no hold-ups through that. But what it does do is it shifts the VAT on import back to you as the importer when you bring that stock into the country. So you need to make sure that if you're recovering that, that your import documentation is in order, and that you are registered domestically to be able to recover that, and of course charge the customer. On the US side, again, the tax doesn't quite so much impact the distribution but it probably was worth bearing in mind that if you do, in many countries, have stock in country, and particularly if you start having some staff there and some warehouse staff to help to fulfillment, you might want to just think about your income tax obligations as well, because if you do have some staff and a fulfillment capability, you might be getting towards a permanent establishment territory. So that's things to probably look out for if you do decide to go owning the stock yourself in country.
Great. Another great detailed answer. Thank you, Morgan. That's great. Honestly, especially being a complete outsider, lots of things people don't think about. And again, so it's good to sort of check in and have, I even liked what you said about sort of a health check in terms of where your business is, or it wasn't a health check, sorry, it was like a
Fitness or something, or
yeah. Or a fitness for where it is sitting with your business and how important it is and the gaps that you may be having. So that's quite cool. Another thing I enjoyed is the tax tools, very practical and helpful. In terms of what you do you support people in how to use those? Do you support people in telling them, you know, how they need to use it for their business? How do you sort of connect yourself in with the tools themselves?
So I don't represent any of those tools. I'm not sort of commission selling. I don't sort of have any bias for any particular tool. I can certainly point people in the right direction, depending on the nature of their business, and help them to make sure that they are within the integrations. The likes of Lara, their integrations are quite smooth. So certainly I can help. There's no one size fits all answer to that.
Totally. Nice. Cool. Another question we hear is for anyone looking at buying or investing into business with export revenue, what would you recommend around avoiding nasty surprises around international tax liability?
So this really comes down to the due diligence, and you know, if there has been previous non-compliance of tax, then those liabilities can continue. So I guess if you're looking at buying a business, you are at high level going to do it either through the purchase through a company, you'll buy shares in the company, or you'll try and buy the assets of that business. And for most countries, if you buy the assets of the business, the liabilities stay with the company, and so you start afresh. That doesn't always work in the US. There's various rules that allow the sales tax liabilities to follow the business. So I'd say if you are doing your tax due diligence and you're selling into the US, don't just assume if you can structure it as an asset sale that you're immune from sales tax, because there is an ability for the liabilities to follow. And if you buy a company, then obviously you need to look at what's their sales profile been. You know, do they have tax liabilities they haven't actually met? Because if you buy that company, you are inheriting all of those historical tax liabilities. And particularly with indirect tax, because the liabilities are based on a percentage of revenue, that number can be quite high.
Yeah, good thing to think about before making a big decision like that, definitely. Okay, do we have more? A couple more. Are there a few fundamental things a business owner looking at selling a software as a service model into export markets should make sure they do?
I think it's probably not just with SaaS products. It's really just understanding, you know, where your customers are and understanding what your tax liabilities are. I think the key thing for SaaS businesses is tracking, if you look at the US, tracking your level of sales by location, because there are individual state thresholds, and so you sort of want to know when you are reaching that threshold. And if you haven't been tracking the addresses of your customers, if you do get an inquiry, you'll struggle to defend any assessments for a liability. So start from day one. You can choose whether or not you're going to start registering and meeting these tax obligations. But the one tip I would give is record your customer locations so that you have that information to track what your exposure is, and you can push back on any challenge should they arise. If you don't report it, your ability to fight will be severely hampered.
Yeah, that's interesting. Great. Last question I'm going to ask is, if someone goes, I need to talk to Morgan more because he knows lots of things about tax and I need to get my head into gear there, how can they contact you?
Probably the easiest way is through LinkedIn. I'm quite active on LinkedIn, so it's
Great.
LinkedIn Morgan Hardy. You can always also follow that through. Do have a website, which I'm starting to put more information on the blog pages there. The website is www.i-tax.co.nz.
Awesome.
But LinkedIn's the easiest way. Flick me an invite to connect, flick a quick question. I do think it's a lot easier to point people in the right direction early rather than try and solve problems later on. It'll save everyone a lot of pain.
Definitely. And a reminder that you are not too small as a business owner, that if you're thinking about growing yourself, growing your company and looking 3-5 years down the track, it's definitely something you need to be in tune with. So thank you, Morgan, so much. We will make sure that we have Morgan's details where we post this exclusive webinar up on Icehouse Central, so that you can go ahead and contact him directly if you do need some further support or ask some questions, and we'll make sure we direct them through to him. But thanks for your time, Morgan. Very interesting, and you're very skilled in the topic and know your stuff. And so thanks for bringing that value.
Cool. Well, I'm just very pleased that you hadn't fallen asleep by the end of it, 45 minutes talking about tax. But thank you for the opportunity to speak here. Thank you.